It is time now for a check of the top business news stories. I'm joined by our business editor, Kate Moody. Hi there, Kate.
Hi, Tom.
Let us begin with the latest from the US Federal Reserve and how it expects the economy to fare as the coronavirus pandemic shows no signs of going away.
Well, America's central bank has, as expected, kept its interest rates near zero and suggested that it's unlikely to change that until 2023. It says it's aiming to keep that accommodative stance and its bond buying program at a higher than usual rate for as long as the economy needs it. The Fed saying it's hoping for inflation of above 2% for some time. The Fed said that economic activity and employment have picked up, but are still much weaker than at the beginning of the year, and that the future of the U.S. economy will depend almost entirely on the state of the coronavirus pandemic. Well, for some insight, we can speak to Christian Lawrence, senior market strategist at Rabobank, New York. Thanks for speaking to us on France 24 this evening. Let's start, if we can, with the federal funds rate. We were expecting that to stay near zero. Were you surprised at all by the timeline, not looking at any change for the next 3 years?
Expected. At Rabobank, we certainly didn't expect the Fed to raise rates before then. And if you look at the market implied probabilities of rate hikes, the market wasn't expecting any rate hikes before then either. So I think this just cements what was expected anyway.
Jerome Powell has given less clarity about how long we expect the bank to continue its asset purchases at this level. It's currently around $120 billion worth per month.
That's right. And I think that that's really been the main driver of markets. It wasn't until we got a lack of clarity onto any forward guidance with respect to asset purchases that we saw the stock market start to head lower. But I certainly think there's a bit of disappointment that we didn't see a longer term commitment to those asset purchases. And that's why we're seeing equity markets start to fall a little bit.
Now, at about 8.4%, the U.S. unemployment rate is already lower than the Fed had initially predicted for the end of 2020. Do you really see that momentum continuing through the end of this year, even as we know that there are more big layoffs looming?
Well, even the Bureau of Labour Statistics admits that because of some difficulties calculating the unemployment rate, in reality, it's probably closer to 9.1%. Of course, that's still better than most expected, but I have to say that I think the bulk of the return of the jobs market has probably happened now, and the pace of job creation going forward is likely to be a lot slower. And it is, of course, mainly these lower income jobs that aren't going to be coming back as quickly, and that bodes very poorly for consumption going forward. So I certainly think the slowdown in the improvement of the labour market is going to feed through into some economic weakness in the coming months.
You mentioned that slowdown that we've seen in some of the economic data, retail sales, factory production as well, not recovering at the pace that the U.S. might have hoped for.
Yeah, and I think a lot of that is to do with the fact that a lot of the fiscal support that we had from the government's CARES Act ran out at the end of July. The extra $600 a week in unemployment benefits ran out at that point. So it's no surprise that people haven't been spending to the same extent. And going forward, unless we get another fiscal stimulus bill from the government, unfortunately, we're likely to see households suffer even more going forward. We could expect retail sales to slow even further. So that's why even the Fed has said that we need some more support from the government in the form of fiscal action.
Yeah, well, you mentioned that stimulus bill that's sort of stalled in Congress for the moment. Mr. Powell did say he thought direct financial support would be needed. If the economic situation deteriorates more, what tools might the Fed still have at its disposal?
Well, as we've learnt since really the global financial crisis back in 2009, unfortunately, the Fed's measures don't tend to trickle down to Main Street. Now, this time around, they did have specific Main Street packages, but the take-up of those has been 0.2%. So essentially, the Fed's actions, they help support shareholders by helping support the equity markets, but they're not really doing much for the average person in the street, particularly those that don't have jobs at the moment. We need help from the fiscal side in order to provide some support for those.
Do you think it's at all significant that this is the last scheduled policy meeting for the Fed before the presidential elections? Has that impacted the language that you've heard from Mr. Powell or the Federal Reserve statement?
No, I don't think so. But of course, this election is, well, it's like none other that we've seen in history. Two very opposite candidates. And quite frankly, when we look at the polling data, yes, it does show Biden in front, but I don't think that we can rule out a Trump victory. So there's a lot of uncertainty around that. And that's very clear when you look at financial markets and you look at what they're pricing in. They're not only pricing in more uncertainty around the election, but actually in the weeks after the election, because there is a growing consensus that we're going to have to wait a while to find out the true results.
All right, Christian Lawrence from Rabobank in New York, thanks so much for joining us on France 24. Let's check in now on the day's trading action. Wall Street is trending higher. It was boosted by that guidance on long-term low interest rates and continued support for the U.S. economy. The Dow Jones up nearly 1 percentage point with less than an hour of trade to go. The Nasdaq still lagging behind, slightly below the flat line. We saw a mixed close for the major European indices. London's FTSE 100 ending nearly half a percentage point in the red. Slight gains in Paris, Frankfurt, and Madrid. Shares of the fashion giant Inditex, the parent company of Zara, jumped 8% after it reported a return to profit following the lockdown. An 18-month investigation by a U.S. congressional panel says that both Boeing and government regulators were to blame for the deaths of 346 people in 2 deadly accidents, which led to the grounding of the 737 MAX fleet around the world. The scathing report describes the dual tragedies as the horrific culmination of failed oversight, design flaws, and a lack of transparency. Families of the victims say that the report exposes what they describe as an unforgivable crime. Luke Schrago reports.
Corporate pressure, a lack of transparency, design flaws, and a lack of government oversight. All to blame for 2 crashes of the Boeing 737 MAX, according to a U.S. congressional report.
Boeing, under pressure to compete with Airbus and deliver profits for Wall Street, escaped scrutiny from the FAA, withheld critical information from pilots, and ultimately put planes into service that killed 346 innocent people.
The 2 jets, one with Indonesia's Lion Air, the other with Ethiopian Airlines, went down within 5 months of each other in October 2018 and March the next year. The MAX was grounded worldwide shortly after. It was suspected at the time the Maneuvering Characteristics Augmentation System, MCAS, was to blame. It was meant to prevent the MAX's more powerful engines tilting the jet up by pushing the nose down. However, an 18-month investigation found the system had been little publicised in an effort to get the aircraft rushed through certification so that pilots wouldn't need extra training. The report blamed not just Boeing, but the Federal Aviation Administration too for farming out oversight to Boeing's own employees and demanded serious reforms to the approval system. Boeing, for its part, said it had taken the recommendations on board when it came to the 737 MAX.
Once the FAA and other regulators have determined the MAX can safely return to service, it'll be one of the most thoroughly scrutinised aircraft in history, and we have full confidence in its safety.
Boeing's already settled most of the outstanding lawsuits from the Lion Air crash. However, families of those on board the Ethiopian Airlines jet are currently demanding that US lawmakers still hold Boeing and the FAA accountable.
Singapore is encouraging the public to take a holiday close to home. The government's handing out $100 vouchers, that's just over 60 euros, to spend in local hotels, restaurants, or attractions. It's part of the Rediscover Singapore campaign, launched in July to support the struggling tourism industry. Overall, the voucher program will cost the government around 200 million euros. Tom, this is in the same vein as the UK's Eat Out to Help Out program, which gave discounts at restaurants for part of the summer, trying to encourage people to get out and spend their money, but really keeping it local.
Okay, so staycations, the order of the day. There's a great zoo in Singapore, by the way. Highly recommend.
I expect they take those vouchers.
I hope so, because that's what I'd spend mine on. Thank you so much, our business editor, Kate Moody. That's it from us. I'll be back in a couple of minutes. Don't go away.